Christophe Nijdam, Finance Watch. You're here today at the public hearing on securitisation to say, have we learnt the lessons of the past? Have we?
The answer is clearly no in that respect. And why? Well, actually, when you look at the STS proposal for simple, transparent and standardized securitization, we haven't learned the lessons from the past. There are 4 points where we consider that it's not doing the job in that respect. The first point is that the proposal includes so-called tranching, and tranching is anything but simple. The second point that we are in disagreement with is that when you want to avoid conflict of interest, that was one of the major problems with previous securitization, then you need to make sure that the bank that arranged the securitization has sufficient skin in the game. That's what we call risk retention. What's on the table is 5%. We think that a minimum of 20% is wishable, because with 5% you're not sure that the bank that's going to underwrite the loan assets under the securitization will do a proper job, a disciplined job. The third point where we have a disagreement also in that respect is that some member of the industry, for instance in asset-backed commercial paper, would like to increase the maturity transformation of the assets in the securitization pack. The problem with that is that, again, we would make the same kind of mistake like in the previous crisis, with a too much liquidity transformation. One of the arguments that was brought in by the industry during that hearing is that there is no problem because we have liquidity backstops provided by the sponsor of the securitization. Well, it's exactly what happened during the crisis in 2008. Private backstop from the banks that did the securitization is not enough. That's among other reasons why a big bank like ABN AMRO went bust, because they were providing the backstop and it was not sufficient. Last but not least, the door is open for what is called synthetics, and the problem with synthetics is that it's a total disconnect between the underlying assets and the securitization that's being created. In other words, when we had the crisis back in 2008, the channel that was used for that to become systemic, what it could have been, circumvented to a few banks here and there, was through the synthetic securitization market. In essence, synthetics enables to duplicate the underlying assets, but does not provide any financing. In essence, synthetics, it's like if you could buy an insurance policy on your neighbor's house, fire insurance policy, and with synthetics, anybody can buy as many as possible of insurance policy on your neighbor. Guess what's going to happen next?
Jonathan Hill is very confident about this proposal. He says that European securitisation market was well functioning, it worked, it was successful, there were very few defaults. What would you say to the Commissioner Hill?
Well, in that respect, it's only one side of the coin. Yes, in terms of default rate, it was extremely low. The problem with European securitization was not the default rate. The problem was market price tanking. Again, we're talking about securities. Securities are tradable instruments. But when the price of the security, because investors are no longer confident, tumble by 80%, which is exactly what happened in Europe, the default rate is no longer the proper criteria. We had huge losses that were taken into account by investors in Europe, be it banks, insurers, and all that. And the real problem is, why would we need to revive a successful market? If it was so successful, we would need to revive it. Actually, the market tanked because market price tanked and because it generated huge losses for investors. So there is some kind of a contradiction by saying, on one hand, it performed very well, let's revive it, and the other hand, investors have lost trust in that market. If you want investors to come back into that market, they got burned once. You have to make sure that you have the proper framework, that this time it's going to be really different with simple, transparent and standardized securitization, which is certainly not what's on the table today.